Hi, I'm Rachel Carpenter, the CEO of Intrinio. In this video, we are going to talk about the biggest trends that we are seeing in data usage during a bear market. Why are we looking at data trends? Well, the types of data that financial experts, app developers, and major quants are buying can be a huge leading indicator. It can be helpful to follow data usage trends during these wildly uncertain times. So, whether you are a fintech founder building an app and trying to keep your users engaged with the latest trends, or you're starting your own hedge fund or building software for trading, this video is for you. Okay, to start off with, a quick reminder that there are three certainties in life: death, taxes, and bear markets. So before we dive into the latest trends in financial data, let's go over some bear market basics. What is a bear market? Simply put, a bear market describes a situation where the stock market is in a period of sustained decline. While there is no hard and fast rule for what constitutes a bear market, investors typically use a 20% drawdown from the latest peak of an index's high to indicate that we've entered a bear market. For example, the S&P 500 briefly entered bear market territory on May 19th of this year, after falling from its latest peak of 4,796 on January 3rd. While the market recovered from the 20% drawdown by the end of the day, closing at 3,900, market conditions have not improved since then. As a result, many investors believe another dip below 3,900 is all but a foregone conclusion. Is a bear market the same as a recession? While both the bear market and the recession have negative economic impacts and are typically associated with one another, there is a distinction between them. As we just went through, the stock market is deemed to have entered bear market territory when there is an overall decline of 20% from the latest peak. But the occurrence of a recession is unrelated to the stock market's performance and is generally defined as 2 consecutive quarters of GDP decline. A reduction in personal income, increases in unemployment, reduced industrial production, and descending sales volume across manufacturing and wholesale retail sectors are some of the main contributing factors taken into account when measuring the consecutive quarterly decreases in GDP. So what causes a bear market? Many factors can cause and contribute to the stock market entering a prolonged period of decline and eventually entering into bear market territory. A few catalysts that have contributed to the latest market downturn are market bubbles bursting, inflation and interest rates, and geopolitical tensions and war. All right. So how long can these bear markets last? Well, according to a study performed by First Trust Advisors LP from 1942 to the present, the S&P 500 has fallen into bear market territory 14 times. Furthermore, the average bear market duration during these periods lasts roughly 11.3 months, with cumulative losses of 32.1% during the period. While 11.3 months is not an insignificant amount of time, it is kind of the price that investors must pay to reap the compounding rewards the stock market has to offer. Highlighting this point, the same First Trust study shows that preceding bull markets on average last 4.4 years and are associated with a cumulative 154.9% total return on average. To paraphrase Morgan Housel, volatility and uncertainty are the cost of admission to entering the stock market theme park and reaping the returns associated with those fees. Okay, so it's likely that bear markets can last almost a year, if not more, and to make matters worse, all of these guys just said they think we're actually headed for a recession next. We're talking Jamie Dimon, Bank of America, even the World Bank. But hang on. Smart investors and founders will see a downturn in the market as an opportunity. So next, we're going to talk about the 3 biggest trends we're seeing in data consumption during this bear market so that you can capitalize on it. Trend number 1. Flocking to fundamentals. Fundamental data is the bread and butter of investment and financial data. This is because knowing the basics like a company's revenue, expenses, debt, and cash flow is critical to most investment strategies. At Intrinio, this data set includes all 3 financial statements, plus hundreds of metrics and ratios like price-to-earnings ratio, basic company information like number of employees and location, reference data, news, notes, sector, industry, and economic data. But the fundamentals of the fundamental data set is what we're seeing trending right now. We're talking the basics of income, cash flow, and the balance sheet. Why? Well, investors typically flock to fundamentals when the stock market takes a hit. Everyone gets tired of overpriced securities, inflated valuations and multiples, inefficient businesses, and bloated metrics. We're seeing app developers who might have traditionally focused on tracking stock price movements via charts start to add fundamentals pages to their software because they know their users will be searching for those basics in this environment. We're also seeing systematic investors, think quant and hedge funds, start to pull more of this data because they're incorporating fundamental factors into their most recent models. Keep your eye on this data set if you want to capitalize on the bear market. And remember, you can get started with a data set like this for as little as $200 a month at Intrinio, and we'll give you a free trial. Trend number 2, hedging with options. The second area of data usage that has been climbing lately is options data. Options are a type of derivative product that allow investors to speculate about the volatility of an underlying stock. To trade options, you purchase a contract that allows you to buy or sell the security at a certain price on a certain date. So options data, like the kind of data included in Intrinio's bronze, silver, and gold packages, typically includes things like the strike price, expiration date, last trade price, size, timestamp, and volume, last bid-ask price, size, and timestamp, open interest, type of contract, plus extras like blocks, sweeps, Greeks, and implied volatility. The increased usage of options data that we're seeing at Intrinio makes sense during a bear market. Options are a great way to hedge against stocks that investors think might tank when things go south. We're seeing our users build retail trading apps with this data to help the explosion of retail investors hedge during uncertain times. We're also seeing some of our professional users who might have historically led with more traditional strategies start to adopt or at least monitor options movement. Historical or real-time options data can be very quickly and easily integrated into apps, software, websites, or algorithms via API, WebSocket, anything you want. So chat with our team if you want to try it out. Trend number 3, monitor the whales. One last pro tip during uncertain times, including bear markets that threaten to turn into recessions, is to pay attention to the whales. Information arbitrage can be a powerful thing, but you don't really want to be on the wrong side of it. And let's face it, we're operating in a landscape of asymmetrical information. So even though there are likely some institutions, CEOs, global leaders, and/or geniuses in their parents' basement who might have more information than you, the good news is that there are several ways of trying to figure out what they're doing with that information. The first is through institutional holdings data. All institutional investment managers with AUM over 100 million are required to file a form called a 13F with the SEC, which discloses the stocks that they hold in their portfolios. The second is through insider transactions data. Insiders in public companies like executives or directors are required to file a Form 3 with the SEC to disclose any ownership they received and a Form 4 every time they trade the company's securities. Many data providers, like us at Intrinio, make it easy to digest both institutional holdings and insider transactions data via API, CSV, or any preferred method. Purchasing it from a data provider ensures quality, timeliness, ease of access, support, and most importantly, that the data is actually structured, digital, comparable, consumable. The third type of data you can use to track the whales during bear markets is unusual options activity. Tracking a data feed like this allows you to see unusually large, if not massive, orders of options contracts. This typically indicates someone or some company that is pretty confident about the direction of a stock. We've got a couple videos that already dive a deeper into this topic if you want to check it out. It's good to be aware of institutional holdings, insider transactions, and unusual options activity during a bear market. And if you're a fintech founder or an investment software provider, remember that your customers need to see and track this information as well. A bear market is a great time to track the whales and integrate these 3 unique data types into your website to keep your customers happy. Okay, now you are up to speed with the 3 latest trends in financial data usage during a bear market. You're going to want to take a look at all of these data sets if you're an investor yourself or managing a fund or algorithm. If you're in the fintech space, it would be smart to think about displaying some of this data to your end users so they can stay up to speed throughout this wild ride. And remember, you can chat with our team at any time by clicking one of the links below or visiting our website at www.intrinio.com. We'd be happy to learn about what you're building and set you up with a free trial for any of the data feeds we talked about today. If this was helpful, please be sure to like this video and subscribe to our channel to see more content like this. Thanks for listening. We can't wait to see what you build.